Good afternoon, traders. Welcome to today's live session. We're diving deep into trading the NZD/USD currency pair. That's the New Zealand dollar against the United States dollar, a major pair that offers solid movement, unique macroeconomic characteristics, and valuable training ground for both new and experienced Forex traders. Now listen closely, this is not just another pair on the watch list. If you want to trade NZD/USD successfully without wrecking your capital, you need to understand what moves it, when it moves, and how to manage your trade from setup to exit. That means we're going beyond the surface, no shortcuts. Let's start with the fundamentals. The New Zealand dollar is considered a commodity-linked currency, and that's your first anchor. New Zealand's economy is heavily export-driven, particularly in the agriculture sector. Dairy, meat, and forestry products make up a significant portion of the country's external revenue. So when global commodity prices rise, especially dairy, the New Zealand dollar tends to appreciate. When those prices fall or demand weakens, the currency often declines. The United States dollar, on the other hand, is the world's primary reserve currency. It behaves quite differently from the New Zealand dollar. It strengthens during global uncertainty because investors rush into safer assets. So immediately, you can see that the NZD/USD pair is often driven by risk sentiment. In a risk-on environment, meaning investors are confident and markets are rallying, money tends to flow into the New Zealand dollar. In risk-off situations, such as during a financial crisis or major geopolitical stress, the US dollar typically surges. So here's your first trading principle: always assess global risk appetite. Use tools like the S&P 500 index, the VIX, and emerging market behavior to gauge sentiment. If markets are calm and growing, the New Zealand dollar often strengthens. If volatility rises or panic spreads, the US dollar dominates. Now let's bring in the central banks. The Reserve Bank of New Zealand and the Federal Reserve, these two institutions set the monetary policy that directly impacts the NZD/USD. The Reserve Bank of New Zealand uses its official cash rate to control inflation, influence growth, and stabilize the economy. If the Reserve Bank of New Zealand adopts a hawkish stance, meaning it raises interest rates or hints at future hikes, it often leads to New Zealand dollar strength. The Federal Reserve, operating on a much larger scale, adjusts the federal funds rate based on US inflation, employment, and growth targets. When the Federal Reserve raises rates or signals tightening, the US dollar strengthens across the board, including against the New Zealand dollar. So your next key concept is interest rate differentials. If the Reserve Bank of New Zealand has a higher interest rate than the Federal Reserve, the NZD becomes more attractive to global investors. That encourages inflows into New Zealand assets, which lifts the currency. But when the differential narrows or flips, the US dollar usually wins out. Now let's talk China. Why? Because New Zealand has deep trade ties with China. A significant portion of New Zealand's dairy and agricultural exports go directly to the Chinese market. That means the New Zealand dollar is also influenced by the health of the Chinese economy. If China's industrial output is rising, if their purchasing managers' indexes are solid, and if the People's Bank of China is stimulating demand, you'll often see the NZD rise in response. Conversely, when China slows down or enters a deflationary cycle, the Kiwi weakens. That brings us to timing and volatility. The NZD/USD pair is most active during two key sessions. The Asian session, which includes the New Zealand and Australian trading hours, and the US session, when most US economic data is released. Liquidity peaks when these sessions overlap. If you're a day trader, this is your window. If you trade during illiquid hours, understand that spreads may widen and price action can become erratic. Now let's get into technical strategy. Start with structure. Look at daily and 4-hour charts for market context. Identify key support and resistance levels. Use moving averages like the 50 and 200 period to gauge trend direction. Watch for price action signals near confluence zones. A bullish engulfing candle at major support in a risk-on environment backed by strong fundamentals? That's a higher probability setup. And don't forget your momentum indicators. The relative strength index can show you if price is overbought or oversold. The MACD can reveal divergences or momentum shifts. Combine these tools not blindly, but as part of a structured decision-making process. Now we arrive at the most important section of today's talk: risk management. Let me be absolutely clear, you cannot survive in this market without protecting your capital. Do not risk more than 1% to 2% of your total account on any single trade. Always use a stop loss and don't move it arbitrarily. Place it where your trade thesis is invalidated, below a swing low, above a failed breakout, or beyond structural resistance. Use position sizing calculators to align your risk with your lot size. Never enter a trade just because you have a feeling. Discipline wins over emotion every time. Next, be clear on your exit plan. Before you even press buy or sell, know where you'll take profits and where you'll get out if the market turns. Consider using partial exits to secure gains while letting part of the trade run. Don't be greedy, respect the market's pace. Finally, incorporate sentiment analysis into your routine. Use the Commitment of Traders report to see how large speculators are positioned in New Zealand dollar futures. If everyone is long, be cautious. If everyone is short, watch for potential reversals. Sentiment extremes often lead to turning points. So to summarize, if you want to trade the NZD/USD pair without blowing your account, understand the macroeconomic drivers: commodity prices, China's economy, and global risk sentiment. Watch central bank policy from both the Reserve Bank of New Zealand and the Federal Reserve. Track interest rate differentials closely. Use both fundamental and technical confluence for trade decisions. Master risk management. Every trade must have a plan. Exit with precision, not emotion. Stay informed with market sentiment tools and economic calendars. Trading the New Zealand dollar against the US dollar is not about gambling or guessing. It's about aligning macroeconomic reality with technical clarity and executing with absolute discipline. I finalize on this note. Let's continue to trade smart, protect our capital, and grow our accounts with patience and strategy.